Do tell. I mean, like, what kind of blog post would you write on a day like this? And I want to know, what would you be thinking about Tesla the whole way up here? And the chart. I mean, we've seen these charts before. I just would love your take on the current environment first.
Well, something like Tesla, when you're asking what's happening today or what's happened in the last week, I think the better question is, how did it get here in the first place?
Right.
I had joked with a friend last week that I think I see more Hondas on the road than Teslas. And he said, OK, you're wrong about that, but let's assume you're right. Honda is worth 1/10 of what Tesla is. So that's the bigger question. I think if we're talking about market volatility in general, though, I think the most important thing any investor can do, amateur or professional fund manager, is just understand the long history of market volatility and realize that when something like this happens, like what we're dealing with today or on Friday, how normal that is over time, even during a very long successful period in the stock market. That the stock market on average over the last 100 years declines at least 10% at least once a year, 20% at least every 2 or 3 years. So then when you deal with something like that, it doesn't feel like it's necessarily broken or something is wrong with the economy, but that this is the cost of admissions that we have to pay in order to achieve long-term returns.
Okay, but now you're feeding the bulls on Tesla, because the other, so I totally take your point. You look at Amazon. I mean, there's a stock that on average drops about 20% a year, has had an incredibly volatile history. Look at how it peaked in '99. Look at the way it's come back from that ever since. So, you know, who's to say? Maybe if you are taking a super long view on Tesla, and then today's declines, you know, whatever's going to happen with the stock this year, that's no big deal in the grand scheme of things.
Yeah, I mean, there have been people who really thought Tesla was overvalued 6 or 7 years ago, and they were making coherent arguments. The first time Alan Greenspan used the phrase irrational exuberance was 1996. And he was right. The market was crazy in 1996, but it kept going another 4 years. Same thing with housing last decade. By any metric, it was a bubble by 2003, but it kept going another 4 or 5 years after that. So just because you can see that something is overvalued, even ridiculously overvalued, I'm not saying Tesla is, because the more broader point is, who knows when that's going to change, particularly with interest rates where they are right now, rather than financial metrics moving markets and being like the major anchor of where stocks can go. It's stories and narratives of where people think the future might go. When interest rates are zero, there's nothing holding back the power of narratives. And now that we're in this spot with 0% interest rates, and we're likely going to be here for a while if you believe the Federal Reserve, that just makes the power of narratives so much more powerful than they've ever been at any point in our lives.
Oh, that's fascinating. So yeah, it's like people can say whatever they want when nothing's leaning against them, right? Everything can grow to the moon in a time like that. There's so much more I want to get into here, but one of the things I want to talk to you about, which is kind of a rare opportunity to do so, is your actual day job. I mean, the collaborative fund. Tell me about the companies you guys are invested in. What evaluations look like? You know, what do you kind of think is going to happen with the economy and COVID from here? Are you in the permanent work from home camp, or though like we're going to be back to normal? You know, how is that affecting the way you invest?
Yeah, so we are a venture capital private equity firm. We invest in companies who use their ability to do good in the world and have sort of this ESG component as an economic competitive advantage. Companies whose ability to do well for consumers, for customers, for employees is not a hindrance on their economic returns. It's actually a competitive advantage at bringing in the most loyal customers, the most loyal employees, the top quality employees, et cetera. That's what we do from the investing perspective. In terms of where we are and where the economy is going, I think there's one thing that I think is overlooked or underappreciated today are the odds, and this is not my baseline forecast, but the odds that 2021 could actually be one of the best years for the economy in history, which sounds ridiculous given what we are dealing with right now. But if you think of the amount of pent-up demand of people who are just so eager to get out of their homes and go on vacation, go back to a restaurant, combined with the incredible amount of government stimulus from both the Federal Reserve and from Congress, and you put those two things together, and if we were to get a vaccine in the coming weeks, the coming months, going into early 2021, put all those factors together, and what 2021 could look like is something most analogous to the end of World War II, where you had an incredible amount of pent-up demand for consumer goods because everything was shut down during the war, combined with a lot of government stimulus from the GI Bill, which set the stage of the economic boom of the 50s and 60s. So again, that's not my baseline scenario, but there's so much pessimism of what's going on, justified pessimism. I think we underestimate how good 2021 could be.